Let us see the next question. AB Ltd has recently approached the shareholders of CD Ltd. So AB Ltd is acquiring company and CD Ltd is a target company which is engaged in, highlight the portion, same line of the business. So both of them are doing same business as that of AB Ltd with a bid of 4 new equity shares in AB for 5 shares in CD. Dear students, it means that say the exchange ratio which is offered is 0.80, that is 4 for every 5, or so there is an alternative, cash alternative of rupees 360 per share. So there are two offers which have been given to us, that is say to the shareholders of CD Ltd that either we can give you exchange ratio 0.80 or we can give you cash of rupees 360. Past records of the earning of the CD Ltd had been poor and the company's shares have been out of favor with the stock market for some time. So it has been given to us that the recent records of the target company is poor and so now it is out of favor for the investors. Pre-bid information for the year ended 31st of March 2015 are as under. For AB Ltd and for CD Ltd, equity share capital information have been given to us. Number of shares have been given. Pre-tax profit, it means that the earning before taxes have been given. Price earning ratio is 11 times. Estimated post-tax cost of equity capital per annum, it means that the cost of equity is given to us. Both AB Ltd and CD Ltd pay income tax at the rate of 30%. Current earning growth forecast is 4% for the foreseeable future of both the companies. So the future growth rate is given to us at the rate of 4%. You are required to answer that. First, assuming, highlight the portion, no synergy exists, means there are no advantages of the merger. You are required to evaluate the proposal share to share offer, that is 0.8, likely to be beneficial to the shareholders of CD Ltd. It means from CD Ltd point of view, you have to evaluate whether it should accept the shares offer or cash offer using the merger terms available. So in the first part of the question, we are required to answer from CD Ltd point of view that whether it should accept 0.8 share of acquiring company or it should accept the cash consideration of 360. That is what's the question which has been provided to us. Yeah, here. I request all of you to give answer for the first part of the question in the chat box. So let us answer the question. Working note number 1. Calculation of MPS of merged firm full stop. Now dear students, what we will do first of all, we'll make the calculation of the MPS of the merged firm from the given information. Let us assume that, just I am taking a random value, MPS of the merged firm comes to rupees 900. We can say that say for shareholders of CD Ltd, there are two things. Either it can offer the cash offer or it can offer the shares offer. If it is accepting the shares offer, then 900 into 0.8, because 4 divided by 5 is 0.8. So that comes to 720. In case of cash offer, it is 360. This 900 I have taken randomly. This is what's the value attributable to them post merger. That will be compared with the pre-merger price. Will compute the profit or loss. If at all in both the options, there is a loss, then in that case we'll advise that you should not go for the merger. One profit, another loss. We'll tell them that you should go for the option which has profit. Both profit will tell them to go for option which is having higher profit. That is the sequence in which we have to do answer. And importantly, we understand that we are required to make the computation of MPS of the merged firm first of all. Its calculation is very simple. Dear students, we can say something like this. It is AB Limited, it is CD Limited, and it is merged firm. That is the way we have to start. We have been provided with the information about earning before taxes. Income tax rate is provided to us, that is 30%. So what happens at the earning before taxes into 1 minus C, that will give the earning after taxes, divided by the number of shares, that will give the earning per share, multiplying with the price earning ratio, that will give the market price per share. Whatever the market price per share into number of shares, that will give us the total market value. Language of the question is very clear. There is no advantage due to merger. So whatever the market value of both the companies before merger will be added, and that is the market value of the merged firm. Exchange ratio information has been given, with which we can compute the number of shares of the merged firm, and afterwards MPS of the merged firm, and so on calculation will be made. That is the way we are supposed to make the calculation of answer. So I request all of you to write down answer along with me. We can start with the earning after taxes. Earning after taxes is found as earning before taxes into 1 minus income tax rate. Earning before taxes is 125 lakhs into 1 minus 0.30. Later on it is 110 lakhs into 1 minus 0.30. That is the way the earning after taxes is calculated. It is 87,50,000. 110 into 0.7, that comes to 77 lakhs. The same would be divided with the number of shares. Number of shares of AB Limited is 2,40,000, and for CD Limited it is 1,70,000. Earning after taxes divided by number of shares will give earning per share. So what will happen? It is 87,50,000 divided by 2,40,000. On the other hand, 77 lakhs divided by 1,70,000. So 87.5 upon 2.4, 36.4583. 77 upon 1.7, 45.2914. 41, sorry. The same will be multiplied with the price earning ratio. Price earning ratio is 11 and 7. That will give the market price of the share. 36.4583 into 11. That is 401.04. 45.2941 into 7. 317.06. That is the way the market price per share can be calculated. The same will be multiplied with the number of shares. So that will give the market value. Market price per share is 401.04 into 2,40,000. 317.06 into 1,70,000. Okay. That is the way the market value will be found. 962.50 lakhs. 317.06 into 1.7. So it is 539 lakhs. And importantly, friends, for the merged firm, we will be having so the total of both of them 962.5 plus 539. So 1501.5 lakhs. The same will be divided with the number of shares. Number of shares of the merged firm will be 2,40,000 plus 1,70,000 into 4 divided by 5. So 2,40,000 plus 1,70,000 into 4 divided by 5. That is the way the number of shares of the merged firm can be calculated. 3,76,000. That will give us market price per share 1501.5 divided by 3.76, that is 399.34. This is the way market price per share of the merged entity can be calculated, considering that there is no synergic gain. Now friends, after making this calculation, we will have further working like this. Calculation of profit or loss to CD Limited. In that, say it is shares offer and another is cash offer. In that case, we will make a comparison like this. Post merger is to be compared with pre merger. As far as the pre merger is concerned, in that we understand it is 317.06. In case of cash offer, we can see that say the price which is offered is 360. So over here we are required to mention 360. In case of shares offer, what will happen, dear students? It is MPS of the merged firm 399.34 into exchange ratio. That is the way we are required to make the computation of the answer. That's the MPS attributable to the shareholders of the target company. So it is MPS of the merged firm into exchange ratio. So it is 399.34 into 0.80. So 319.47. So difference of both of them is a profit or loss. So 319.47 minus 317.06. So there is a profit of 2 rupee 41 paise. And 360 minus 317.06. There is a profit of 42 rupees 94 paise. In both the cases, say there is a profit. But of course, we can see that in case of cash offer, it is higher profit. So cash offer is supposed to be preferred. Please write an answer. Second part of the question. AB Limited's director might expect their own pre-bid price earning ratio to be applied to combined earning. Whether merger terms are favorable for CD Limited, that is a question. Again, I request you to do answer and put your answer in the chat box. So friends, over here the question is providing the information that the price earning ratio is likely to remain same. So taking into account this revised information, we are required to calculate MPS of the merged firm. So in order to give answer for the second question, I request all of you to write an answer along with me. Working note number 1, calculation of MPS of the merged firm. In that, we will have answer like this. We'll start with the earning after taxes. Dear students, we understand that there is no increase in the earning. That is what's the kind of assumption that we will have. So it is 87,50,000 plus 77 lakhs. That is the way earning after taxes of the merged firm will be calculated. So it is 87,50,000 plus 77 lakhs. That is 164.5 lakhs. Number of equity shares we already have calculated. It is exchange ratio 0.8 into 1.7 plus 2.4. That we already have calculated 3,76,000. Now this will give us EPS because these two things have already been found. It is 164.5 lakhs divided by 3.76 lakhs. 164.5 divided by 3.76. So it is 43 rupees 75 paise. Multiplied with the price earning ratio. Because the question says that the price earning ratio is going to remain same. That will give MPS. That is EPS into price earning ratio. So 43.75 into 11, that is 481.25. Okay, this will give the market price per share. Once we compute the market price per share, after that, we are required to make the computation of the profit or loss to shareholders of CD Limited for consideration of shares. Because for cash, we already have found it and that is not going to change. So we understand that the calculation of profit or loss to shareholders of CD Limited for shares consideration. It is MPS of the merged firm into exchange ratio minus MPS of CD Limited. So it is 481.25 into 0.80 minus MPS of CD Limited. It is an amount of 317.06. So it is 67.94. So we understand that say finally we are required to make a comparison like this. That in case of share offer and in case of cash offer. For cash offer we already have found it. It is 42.94. And for share it is 67.94. So we'll select an option which is say better in terms of the profit. So the share offer is acceptable in this case. So let on with paragraph. shareholders of CD Ltd will be beneficial will be benefited in cash offer, comma, if there is no synergy. Full stop. Shareholders of CD Ltd will be benefited in shares offer if price earning ratio will remain same. This is the way we are required to draw the conclusion. Third part of the question, also comment on value of the two companies from constant growth form of dividend valuation model, assuming all earnings are paid out as dividend. So if at all the entire earning is paid in form of dividend, then in that case, what is the valuation? Dear students, we have been provided with the information that there is cost of capital of 12% and 10%, and further we have been provided with the information about the growth rate. You can see that the growth rate is 4%. So over here we understand something like this. Everybody is requested to pay attention. The question says that you are required to comment on value of the companies. Means before we uh, pass comment, basically we are required to compute the value. So first of all, what we will do, we'll do the valuation of AB Ltd and we'll do the valuation of CD Ltd, taking into account the cost of capital, taking into account the growth rate, and taking into account the earning. We already have calculated earning per share over here. So taking this earning into account, growth rate into account, cost of capital into account, we are required to do the valuation. This is what we are supposed to do. So let us do valuation first of all and then we'll pass the comment. So answer for the third part of the question, in that write down working note number 1, calculation of price per share using growth model. So in that AB Ltd, CD Ltd. Next is the earning per share, which we already have calculated over there. Then P0 will be calculated. For P0 we will be having earning per share into 1 plus C divided by K minus C. That is the way the P0 is supposed to be found. Earning per share is 36.4583 and 45.2941. So it is 36.4583 and 45.2941. Discounting rate is provided to us over here 12 and 10, and growth rate is given to us as 4. So we understand that it is like this: 36.4583 into 1.04 divided by cost of capital minus growth rate. Next, 45.2941 into 1.04 divided by cost of capital minus growth rate 0.10 minus 0.04. This is the way the price can be calculated. So 36.4583 into 1.04 divided by 8 percentage. So 473.96. And for CD Limited, 45.2941 into 1.04 divided by 6 percentage. So 785.10. Okay. Now you can see that so the question is also providing, that is we have calculated current price. We have computed the current market price of the share of both the companies. It is 401.04 and it is 317.06. So 401.04 and 317.06. So friends, what will happen? Understand carefully. Now the comment portion starts. Okay, the valuation is done. Now I'm explaining the comment portion. See, basically the value of the company using this constant growth model approach should be 473, but it is only 401. So it is underpriced. If at all we want to make the computation of the what is the percentage by which it is underpriced, then it is 473.96 minus 401.04 divided by 473.96 into 100. So it is underpriced by 15.39 percentage. In a way that say 401.04 is the price in comparison to 473.96 divided by 473.96 into 100 for getting answer in percentage term. So it is underpriced by approximately 15.39 percentage. In comparison to that, so the CD Limited is also underpriced, but you can see it is huge, substantially underpriced. The price is only 317.06 in comparison to 785.10 divided by 785.10 into 100. So we understand that it is 317.06 minus 785.1 divided by 785.1 into 100. It is underpriced by 59.62 percentage. Now why it is so much underpriced? For that a reason is provided to us at the beginning of the question. It has been provided to us like this. Past records of the earning of the target company CD Limited had been poor and the company's share have been out of favor with the stock market for some time. So the recent performance of the company is not good. That is the reason so the media reports are criticizing CD Limited. And because of that, so the price of the security is substantially less. It is only 317.06 in comparison to its fundamental value of 785.10. Like that, it is substantially underpriced. So the comment is, listen carefully now, we can advise AB Limited that say this is what say a very good time to acquire CD Limited. Why? Because the shareholders of CD Limited will keep this price into account for the purpose of negotiation. And we know that say actually the worth of the company is this much. So we will be able to acquire a company at a substantial discount. Because whatever the price that we give, say which is more than this but less than this, that will give an advantage to us. So from AB Limited point of view, we can say that this is a very good time for acquisition of the CD Limited. This is the kind of comment that we are supposed to pass. Friends, over here it has been given to us that all earnings are paid in form of dividend. So basically the growth rate should be 0 because retention ratio is 0. Yet over here we are making the computation of the answer using earning capitalization method. Whatever the valuation that we have done is based on the earning capitalization method, and based on that we are going to pass a comment regarding the acquisition of the target company. So please write an answer of the question. We can observe that both companies are undervalued. Full stop. However, CD Limited is highly undervalued due to its past records of earning. Full stop. However, fundamental value in bracket I am writing earning capitalization method value is more, comma, so from AB Limited point of view, there is a very good opportunity to take over CD Limited by offering a premium over its current market price of 317.06. Full stop. So let us have understanding of the answer of this question. Dear students, giving summary of the entire answer. In the first part of the question, it has been given that say from the shareholders of the target company, you are required to decide that say whether it should accept the cash offer or shares offer. We have computed the MPS of the merged firm. We have computed the MPS attributable to the shareholders of the target company. The same is compared with the MPS of the target company before merger. Difference of both of them is positive. However, in case of cash offer, there is more advantage. So the company is advised to go for cash offer. In second part of the question, it has been given that the price earning ratio of the merged firm will be same as price earning ratio of AB Limited before merger. So taking into account the EPS of the merged firm and price earning ratio, we have computed MPS of the merged firm. MPS of the merged firm is multiplied with the exchange ratio and it is compared with the MPS of the target company before merger, and with that say again we can see that so there is a profit, and this time the share offer is more beneficial. That is the way we have to give answer for the first and second part. The third part of the question in my opinion is very important, in which the growth model is supposed to be used, or we can say that in short earning capitalization method. Using that say we compute the fundamental price of the security. Fundamental price of the security is compared with the price of the equity share, that say which is prevailing right now. We can see that say both the company's securities are undervalued. However, the target company's price is substantially undervalued. So from acquiring company point of view, that is a best advantage to take over the target company by offering a premium over the current market price, which is substantially undervalued. This is the way we are required to give answer for the question.